All right, thanks everyone for reading through those disclosures. As I said, my name is Natalie Beckett and I will be your moderator this afternoon for today's webinar featuring Chuck Hughes. Chuck, are you with us?
Yes, can you hear me?
Yes, I can. Nice to have you. For those of you who don't know, Chuck is an 8-time international trading champion, so we're very excited to have him with us this afternoon. Chuck, I'm going to go ahead and give you the reins, and you can take it away whenever you are ready.
Okay, great.
Here we go. Coming over to you right now. Perfect. I can see your screen.
Okay, good. Let me get into the slideshow mode. Okay, great. It's great to be here today, everyone, and thank you, Natalie, for setting up the educational webinar. Over the years, I've learned a lot from giving these webinars from questions that viewers asked, and I did research on the question, and that led to some of our trading strategies today. So I learned from these webinars as well. So today we're going to talk about ETF trading, and in particular, we're going to look at trading covered calls on ETFs, trading weekly covered calls on ETFs. And we've been doing this strategy since 2011. The weekly calls were introduced in 2010, and in 2011 we started taking advantage of trading covered calls using weekly options because we can sell an option premium every week throughout the year. So it's a very lucrative strategy as far as taking in cash premiums from selling covered calls, and it's a lower risk strategy because you're buying the ETF and selling a call, and of course the call gives you downside protection. So this would be considered one of the lower risk strategies, option strategies. And I think the ETF covered call premiums, collecting those premiums every week, can give you a totally different perspective on income investing. If you invest in stocks and you get a 3 or 4% annual dividend, that's considered good. But with selling the ETF covered call premiums each week, you can do a lot better than that. So writing the ETF covered calls allows you to collect option premiums, which are cash credits to your brokerage account. So when you sell an option premium, there's a cash credit to your brokerage account when you sell the option premium. There is a risk of loss with covered calls, but the option premiums that you receive can help reduce this risk. And once the cash hits your brokerage account, it's yours to keep, and you can do whatever you want with the cash premiums that you receive in your brokerage account. We here at Hughes Optioneering, we reinvest the cash premiums we receive every week into additional covered calls, and that allows us to compound our returns over time. And when you sell a covered call premium, you get to keep that premium no matter what happens to the price movement of the underlying ETF. And over the course of a year, we can collect option premiums that, if you add them up over the course of a year, they can exceed the original cost basis to purchase the 100 shares of the ETF. So you essentially get all your money back in cash over the course of a year. And this low risk income strategy is permitted by the IRS for use in IRA and retirement accounts. And we here at Hughes Optioneering, we do use this account in our retirement accounts. And another advantage to this strategy is that you can start out small. You only need a $3,500 trading account to purchase 100 shares of an ETF and start collecting a weekly covered call premium, option premium. and we do this regardless of the direction of the stock market. And I'll show you in a few minutes what we do in bear markets, and what we did in the last severe 2008 bear market is we traded these weekly covered calls on, not weekly covered calls, but monthly covered calls on inverse ETFs, which go up in value as the underlying stocks go down in value. So you can trade these weekly covered calls in bear markets using inverse ETFs. And as I mentioned, we did collect covered call premiums. At the time, they only had monthly options, but we would buy 100 shares of an inverse ETF and sell call option premiums each month against our 100 shares of the ETF. So we were able to profit during the 2008 bear market. And we wrote a book on trading these weekly covered calls, and in the book we showed that in 2008 we had more than $598,000 collected from these option premiums during 2008. So those trades are listed in our book on covered calls. And as I mentioned, in bear markets we use what are called inverse ETFs that profit when the stock market's going down. So that's good to know, because at some point we will go into a bear market and we can still trade and receive income during bear markets using these inverse ETFs. And the good thing about the inverse ETF, it's not like going short a stock or going short an ETF, because you have virtually unlimited risk if you're short an ETF or short a stock and the ETF goes up in price or the stock goes up in price. So you don't want to be in that position where you have virtually unlimited risk with a short position. So these inverse ETFs allow us to, they are a bearish position, but they allow us to trade during bear markets without taking on all the risk of a short position. So the ETF covered call strategy generates cash income from selling the call option premiums on your ETF shares. And the strategy for us has produced consistent returns during volatile and non-trending types of markets too. We had, since the recovery in 2009, we had a few years there, 2010, 2011, 2012, where there was a lot of volatility, but very little trend, and we were still able to profit during those non-trending types of markets with these weekly covered calls. So a lot of investors are not familiar with the concept of selling call option premium to generate cash income. And selling option premium is a very simple but lucrative income strategy. And the strategy is also known as a buy right, because you're buying 100 shares of a stock or ETF, and then you're writing or selling a call option. So when you sell a call option, cash equal to the option price or the premium is immediately credited to your brokerage account. So one option covers 100 shares of an ETF or stock. So if you buy 100 shares of an ETF and you sell a call option with a 2-point premium, you'll receive a $200 cash credit in your account. 2 points times 100 shares would be $200. So if the option premium is trading at 2 points and you sell it at 2 points, then you'll get a $200 cash credit. Now we own 1,000 shares of the small cap ETF, symbol TNA, and each week we sell 10 call options to generate income from our 1,000 shares of TNA. And here's an example of a cash payout for selling an option premium. So our brokerage transaction history shows that we sold 10 of the TNA September 2nd. That's a weekly call right there, September 2nd. We sold the 75 strike call at 320. So when we sold 10 of these options, 75 strike calls at 320, that generated a $3,200 cash payment that went into our brokerage account minus the $15.80 commission. So the net result from selling the 10 calls was, and you can see right here, is our brokerage account was credited with $3,184 in cash from selling those 10 options at 320. So this is how you can generate cash income each week by selling these call options. So the ETF covered call strategy is easy to implement. You simply buy 100 shares of an ETF and then you sell a call option. And this can be done in a regular brokerage account, and it's similar to trading stocks. You would just buy 100 shares of an ETF, and then you would sell to open one call option. And we normally, with the covered call strategy, we normally just sell the at-the-money call option. So let's look at a covered call trade we took. Our brokerage confirmation shows that we bought 100 shares of ERX, and ERX is the energy ETF. It's the leveraged energy ETF. So we bought 100 shares at 31.479, and if you add the brokerage commission in there, the cost to buy the 100 shares was $3,155. So that's the first part of establishing a covered call position. You buy 100 shares of an ETF or a stock. So in this example, we bought 100 shares of the leveraged energy ERX ETF at 31.479, and after the commission, we paid a total $3,155 to buy the 100 shares of ERX. So that's the first half of the covered call trade. So at the same time, we sold to open the ERX September 2nd 31 strike call at 1.10 points. So we sold short one ERX September 2nd 31 call, and we collected a 1.10 point premium. And after the commission, that came out to a credit of $101 in our account for selling that September 2nd weekly option. So in 1 week, that September 2nd option will expire, and then we simply will close out the short call. That way we get to keep the 100 shares of ERX in our account, and then we'll sell the new weekly option. In this example, we would sell the September 9th weekly call. Okay, so the September 2nd call is known as a weekly option. Weekly options expire on Friday, and there's 52 weekly option expirations over the course of 1 year. So each Friday, the weekly option expires, and over the course of a year, you'll have 52 of these expirations. And you can see from the brokerage account, a transaction report I just showed, that when we sold the September 2nd 31 strike call at 110, we received a $110 cash credit to our brokerage account minus the commission, so it came out to $101 in cash credit to our brokerage account. And of course, we get to keep this $101 cash payment regardless of the price movement of ERX. So when you put on a covered call trade, there's two possible outcomes, and the first outcome is, and we sold the 31 strike call. So on September 2nd, which was the expiration for that weekly option, if the ERX ETF, if it's trading above 31, which again is the strike price of the call option we sold, then the ETF will be called and the 100 shares of ERX in our account will be sold at 31. So if the ERX is trading above 31, which was the strike price that we sold at expiration, then the 100 shares of ERX will be called, and this is all done automatically at option expiration. So whenever the stock or ETF is called, then you realize the full profit potential for the trade. So the first scenario is if it's trading above the strike price we sold, then it will be called and 100 shares will be sold at the strike price. In this case, was 31. And the second scenario is if the ERX is trading below 31, then your 100 shares will not be called, and you get to keep the 100 shares in your account. And if so you get to keep the premium you sold, and you also get to keep the 100 shares in your account if the stock or ETF is trading below the strike price of the call that you sold. So in this case, if ERX is trading below 31 at expiration, then we get to keep the premium and we get to keep the 100 shares in our account. And if the 100 shares of the ERX drop in price over that 1 week period that we held it, any loss will be reduced by the $110 cash payout you received. So if it's not called, you keep the stock, you keep the premium, and if ERX goes down in price, then any loss on your on a price drop on ERX will be reduced by that $110 cash payout. So we like to just simply keep the shares of our ETFs in our account. So what we do each week at option expiration on Friday is we'll roll over the expiring call option at expiration, and that will prevent us from being called. So we like to keep the shares in our account, so we simply roll over the expiring option so we can keep the shares in our account. So let's look at an example of a rollover, and this is for the weekly ERX September 2nd call option that we sold. Remember, we sold the 31 call at 110. So on September 2nd, this option will expire. So we want to roll it over, and the way we do that is we close out this September 2nd short call. We'll just put an order in to buy to close the expiring September 2nd call, and then we'll sell to open the September 9th call, which expires 1 week later. So so you can see on September 2nd, we closed out the September 2nd call, which was expiring, and then we sold short the September 9th call at 165. So we collected a little bigger premium on the September 9th option, and the net amount was $156. So closed out the expiring September 2nd call and then sold to open the September 9th call. So that way we get to keep the shares of the ETF in our account. And then on September 9th, we would close out the expiring option and we would sell to open the September 16th option, which expires in 7 days. So you can see September 9th, we closed out our September 9th option, and then we sold short the ERX September 16th option. We collected a $135 premium. Net result was $126. So each week we close out the expiring option, sell to open the new option, and then we can keep collecting premiums and keep the shares of the ETF in our account. And if there's a week where you forget to roll over the expiring option, you get too busy and you forget about it. If the ETF is trading above the strike price at option expiration that you sold, then your 100 shares will be called. If it's not trading above the strike price that you sold, then you'll keep the ETF shares. But if for some reason you forget to roll it over and the shares are called, then you can simply buy another 100 shares of the ETF and then sell a weekly call option to reestablish your covered call. So if you forget to do it at expiration, it's not a big deal. It'll just get called, and you could just buy another 100 shares and sell another weekly call option to reestablish the covered call. So when at rollover on Friday, if it's a weekly covered call, we normally use what is known as an option spread order to roll over our weekly covered calls. And option spread orders, it's one order, and it closes out the expiring option and it sells to open the new option, and that allows you to keep the shares of the ETF in your brokerage account. So we use one spread order to close out the expiring option and to sell to open the new option. And here's an example of this. This is for the emerging market ETF symbol EEM. And what this shows is a snapshot of the actual order we use to roll over the expiring. In this example, the February 24th weekly option was expiring, and the March 2nd option was the new option. So we used this spread order, and we bought to close the 5 of the February 24th weekly calls, which were expiring, and then we sold to open 5 weekly calls, the March 2nd weekly call. So buying to close the expiring options February 24th and selling to open the March 2nd option. So with one order, we're able to do these rollovers, and that can help you save on commission costs. And also, we normally put these orders in halfway between the bid and ask price on options, and we normally can get filled close to halfway between the bid and ask price. So you not only save on commissions, but you can save on the cost of the bid-ask spread whenever you trade options. So using the option spread orders, again, can help you reduce commission costs and the option bid-ask spread transaction costs, and also allows us to keep the ETFs in our account. Here's another example. This is for TNA. That's the small cap ETF, symbol TNA, and we owned 800 shares of TNA, and we were short 8 of the November 23rd weekly options. So we wanted to close out these expiring options, and then we sold to open the November 30th calls, which expired 1 week later. So again, we used a spread order to close out the expiring option and sell to open the new option. And this allows us to save on commission costs and the bid-ask transaction costs. So when you receive these, if you're doing weekly covered calls and you're receiving these cash premiums every week, that allows the covered call strategy to incur less risk than owning a stock or an ETF, because you're receiving that cash premium every week. So let's take a look and an example of a covered call trade we made, and the trade was profitable even though the underlying stock declined in price. So let's just take a look at a trade example, and this demonstrates how the covered call strategy is actually less risky than just owning a stock or owning an ETF. So in this example, our brokerage confirmation shows that we bought 1,500 shares of Mosaic stock. That's an agricultural company at an average price of 42. So you can see we bought 1,000 shares at 42.05. We bought 500 shares at 41.90. So this averaged out to an average price of 42 for buying the 1,500 shares. And then we sold 15 of the Mosaic 40 strike call options at 7.90, average price of 7.90. So we bought 1,500 shares of the stock, sold to open 15 call options at 7.90. So selling the 15 contracts at 7.90, that resulted in a cash credit of $11,850 before commission. So sold 15 contracts at 7.90. That translates to $11,500 in cash payouts for the option sale. So that cash payout provides downside protection if Mosaic stock declines in price. So what we did is, after we initiated this covered call, the Mosaic stock did go down in price. So again, you can see we bought the 1,500 shares of Mosaic stock, and we sold the 15 call options at 7.85, and the stock declined in price. So you can see for the stock part of this covered call, we had an open trade loss of $1,633. So we just took a snapshot of this covered call as an open trade just to demonstrate that even though we had a $1,633 loss on the stock, we had a $5,187 profit on the short calls. So here's a case where we initiated covered call trade, the stock went down, but the option side of the covered call profited. So we had a net profit of $3,553 for this trade, even though the stock went down in price. So that just shows that the covered calls are less risky than just simply owning a stock or an ETF. So let's now look at the criteria we use for selecting ETFs for covered calls, and we're talking about weekly covered calls now. So we have three simple criteria for selecting these ETFs. The first criteria would be that the ETF trades weekly options. Now, not all ETFs trade weekly options. Some only trade monthly options, but we like to focus on the ones that trade weekly options, because over the course of a year, we're going to collect 52 premiums instead of 12 premiums. So we're going to collect more option premium. So that's the first criteria. The second criteria is that the ETF's option premium, the weekly premium, gives you at least a 1 to 2% weekly cash premium. So we're talking about selling weekly covered calls here, and we sell the at-the-money strike price. So we want to see at least a 1 to 2% weekly cash payout. So over the course of a year, if we can collect a 2% payout each week over 52 weeks, then we'll receive a 100% cash payout that would cover the cost, the initial cost to purchase those 100 shares of the ETF. So We like to see at least a 1 to 2% weekly cash payout. That really adds up over time, and if you're able to get that 2% premium, and you do that every week, then you can recover the total cost that you spent to buy the 100 shares of the ETF. And then the third criteria is that we want the price of the ETF to be trending up, and we just look at the 10-month simple moving average, make sure the ETF is in an uptrend. So let's look at an example. The energy ETF symbol ERX was trading at $39.91 on Friday, December 30th. So you could establish a weekly covered call, an at-the-money covered call on that Friday by selling the 40 strike call. So the ETF was trading at $39.91, and if you were to initiate a weekly covered call that expired 1 week later on January 6th, then you would be selling the 40 strike call, as this is the strike price closest to the price of the ETF. So in this example, ETF trading at $39.91, we would normally sell the 40 strike call because that's closest to the price of the ETF. So a weekly covered call could be initiated by purchasing 100 shares of ERX at $39.91 and selling to open the 140 strike call, which is the at-the-money call. So the ERX 40 strike call, the at-the-money call, was trading at 110, and selling that 40 strike call would generate a $110 cash credit to your account. And if that result, $110 cash credit, would be a weekly premium of 2.75%. So in this case, we would meet our criteria of collecting at least a 1 to 2% premium each week for the at-the-money call. In this example, this is actually 2.75% premium that week. And the way you calculate that is you just divide the 110 premium you collected by the price of the stock at the time, $39.91. So that 110 premium we collected was 2.75% of that $39.91 cost of the stock at the time. So that would allow us to meet that second criteria of collecting at least a 1 to 2% payout each week. So let's look further into this trade. So let's say that we did buy the ETF at $39.91, and we did sell the 1 week call at 110. We would collect $110 premium, and that would reduce the cost basis of the ERX shares to $38.81. So they were trading at $39.91. We sold the 40 strike call at 110. So when we received that cash, $110 cash, that reduced the cost basis of the shares from $39.91 to $38.81. And if ERX closes at 40 or above at that, which is the option price that we sold, the 100 shares would be called, and we would sell them at 40. So if we sold the 40 strike call and the shares were called 1 week later, we would sell the 100 shares at 40. And our cost basis was $38.81 because we got the $110 credit. So that would result in a $119 profit for the trade if the shares were called. So that represents a 3% return for this trade in 1 week. So again, if you if you buy the shares at 39.91, you receive the 110 call option premium that reduces your cost to 38.81. If the ERX gets called, we're going to sell it at 40 minus our cost, so we have a 119 profit. And if you divide that 119 profit by our cost basis of 38.81, that's a return for the week of 3%. So that's a pretty good return for a 1 week trade. And then, of course, on January 6th, we can sell another option premium. So in this case, if the stock gets called, we get a 3% return for the week. And if the ERX was flat at 39.91, that would result in a 110 profit. So again, with the stock trading at 39.91, if it was flat at expiration and stayed the same minus our 38.81 cost basis, we'd have a 110 profit if the ERX stayed flat. So if it's up, if it closes above 40, we're going to have a 3% profit for the week. If it closes flat at 39.91, we're going to have this works out to a 2.75% return for the week if the stock is flat. So if the ERX was down slightly at option expiration, as long as it closes above the 38.81 cost basis, it would result in a profit for the covered call trade. So if it's down slightly but closes above 38.81, which is our cost basis, then we'll realize a profit. Now, any close below the 38.81 cost basis would result in a loss for the covered call trade, and you could sell another option at expiration, another weekly option, and that would help mitigate the loss. So if the ERX is up at expiration, it'd be a 3% return. If it's flat at expiration, it'd be a 2.75% return. If it's down slightly and closes above the cost basis, then we would still profit. The only way we'd lose on this trade if it closes below the cost basis. So on January 6th, the 40 strike call could be rolled over by closing out the 40 strike call and selling to open the January 13th at the money strike call to collect another weekly premium. So again, to roll over, we would buy to close the January 6th 40 strike call, which was expiring, and we would sell to open the January 13th strike, January 13th at the money strike call. So with the rollover, we would be closing out the expiring 40 strike call and selling another at the money call. So let's talk about leveraged ETFs. The energy ETF symbol ERX is a leveraged ETF, and it holds a basket of energy-related stocks, and it's a 3 times leveraged ETF. So according to the prospectus, the ERX ETF seeks daily investment results before fees and expenses of 300% of the performance of the Energy Select Sector Index. So this is a 3-time leveraged ETF. And with a 3 times leveraged ETF, if the energy sector is up 1% for the day, then ERX would be up 3% for the day if it meets its investment goal. And if the energy select sector is down 1%, then it would decline 3% if it meets its goal. So again, if a 3-to-1 leverage, if it's up 1%, you'll have a 3% move in the triple leveraged ERX. If it's down 1%, you'll have a 3% price decline in the ERX. Okay, so the third criteria for selecting ETFs is that the ETF is trending up. And the covered call strategy in general is a neutral to slightly bullish strategy. And we realize the full profit potential for a covered call when the stock closes at or above the strike price of the at-the-money call at expiration. So we saw in the example of the ERX December 30th, the ERX was trading at 39.91, and we sold the 40 strike call. So it only has to go up 9 cents in this example, and it would be in the money, and you would realize the full profit potential. So ETFs or covered calls in general, you don't need a big price movement in the underlying stock or ETF to realize the full profit potential. So, that's if you're selling the at-the-money call. So each week, you're just looking for the stock basically, or the ETF, just to be flat or maybe up slightly. So in general, it's a neutral to slightly bullish strategy. And we only trade ETFs that are in a price uptrend, and then we avoid ETFs that are in a price downtrend when we enter these covered call trades. So we just simply look at the price trend of the ETF. We want to make sure it's trending up before we initiate the trade. And the reason we do that is if the ETF is in a price downtrend and the price is trending down, the ETF price over the course of the week could exceed the cash payout that you received. So let's say you received a 110 premium for that. If the ETF is down 150 for the week, then that would exceed the cash payout you received, and you have a loss on the trade. So we found it's better to just simply focus on ETFs that are in a price uptrend to reduce that risk of the price decline of the ETF exceeding the weekly cash payout that you received from selling the call option. So we're just looking in general for the ETF to remain flat or maybe up slightly. So we just avoid ETFs that are in a price downtrend. There's no need to do that because there's plenty of ETFs in a price uptrend. So we use a simple trend following system to determine the price trend of an ETF. We look at the 1-month price of the ETF in relation to its 10-month simple moving average. This is a very common indicator, this 10-month simple moving average, and we're just looking to make sure that the 1-month price of the ETF is above that 10-month simple moving average. So moving averages are a simple method for tracking the current price trend of an ETF, and that allows us to trade with a trend instead of trying to predict the future price movement of an ETF. So if the 1-month price of an ETF is above its 10-month simple moving average, then that ETF is in a price uptrend. And if the 1-month price of the ETF is below the 10-month simple moving average, then the ETF is in a price downtrend. So this simple system's been very effective in identifying the price trend. Here's an example. This is for the triple Qs, and we can see this red and black line right here. This is the monthly price movement of the triple Qs, and this blue line right here is the 10-month simple moving average. So we can see back in July right here, the monthly price closed above the 10-month simple moving average. So once the 1-month price is above the 10-month simple moving average, then that ETF is on a buy signal. And as long as the 1-month price remains above the 10-month simple moving average, then we can write covered calls on that ETF. So you can see 1-month price crossed above the 10-month simple moving average, stayed above the 10-month simple moving average. So we could initiate covered call trades as long as that 1 month price is above the 10-month simple moving average. Now, if the 1 month price closes below this 10-month simple moving average, then we don't want to initiate covered call trades. And you can download the 1 month price and the 10-month simple moving average from stockcharts.com. And if you want to download, first you type in the symbol. In this case, in this example, we typed in SPY for the S&P 500 index spiders. And under period, you would select monthly because we want to look at the monthly price. And again, we typed in SPY. Under period, we selected monthly, and then in the overlays section, we want to select moving average simple, and then under parameters 10. So that will give us the 10-month simple moving average for the SPY. And if you click update, then that will create the price graph, and we can see that this black line here is the 1 month price of the SPY, and this blue line is the 10-month simple moving average. So as long as that 1 month price is above the 10-month simple moving average, then we can initiate covered call trades for that ETF. So let's talk about trading the ETF covered call strategy in bear markets. And as I said before, in the 2008 bear market, we did trade these covered calls on inverse ETFs. So one of the advantages of ETFs over stocks in a bear market is that you can trade weekly covered calls on bearish ETFs. And bearish ETFs increase in value as the underlying basket of stocks decline in price. For example, the 3 times bearish energy ETF is symbol ERY, and that seeks daily investment results before fees and commissions of 300% of the inverse of the performance of the energy sector index. So if the underlying basket of stocks go down in an inverse ETF, then the ETF price will go up. So they're known as inverse ETFs, and we can trade these in bear markets. So in a bear market, you could trade covered calls on the ERY, which is the inverse energy ETF, and other stock ETFs, and they would probably be in a price uptrend according to the 1 month and 10-month simple moving average system. So the ERY and other inverse ETFs in a bear market would probably be in a price uptrend, and therefore we could write covered calls on the inverse ETFs because they'd be in a price uptrend. So you don't have this flexibility when you're trading stock covered calls. You can only trade them one way, and that's the bullish side of the trade. But with these inverse ETFs, they're bearish positions, and we can trade those in bear markets. And as I mentioned, during that severe 2008 bear market, we collected over $598,000 in option premiums with these inverse ETFs. And those trades are listed in our book that we wrote on covered call trading. So let's look at a price chart of an inverse ETF. This is the inverse S&P 500 index, and this is back in 2008. So the black and red line right here, that's the monthly price movement of the inverse ETF, and the blue line is the 10-month simple moving average. So we can see that the inverse ETF was in a price uptrend because it's the inverse of the movement of the S&P 500 index. So the S&P 500 index was declining, and the inverse ETF was increasing in price and was in a price uptrend, so we wrote covered calls on inverse ETFs. And the nice thing about trading the inverse ETFs is your risk is limited to the cost of the ETF, and that's not the case if you're short a stock or you're short an ETF. You have virtually unlimited risk if the stock or ETF continues to move up in price. So with the inverse ETFs, your risk is limited to the cost of the ETF, and you don't have any risk beyond that, so you can't get a margin call. So that completes the presentation for today.